Past performance may not be indicative of future results. Therefore, no current or prospective client should assume that the future performance of any specific investment strategy, including the investments and/or investment strategies recommended and/or purchased by advisor, or product made reference to directly or indirectly will be profitable. Different types of investment involve varying degrees of risk, and there can be no assurance that any specific investment will either be suitable or profitable for a client's investment portfolio. No client or prospective client should assume that any information presented serves as the receipt of or substitute for personalized investment advice from the advisor or any other investment professional.
Welcome to the Bullington Capital Report, hosted by Bill Bullington. For the next hour, you'll receive information on current market conditions and trends that could affect your financial future. If you have a question, you can participate in today's program by calling 216-901-0945. That's 216-901-0WHK. You can also reach Bill by going to his website, bullingtoncapital.com. And now, here's Bill Bullington.
Well, welcome back. That is some intro and suddenly off. Hey, this is Bill Bullington. I'm here every Saturday morning, 11 noon. I'm in the studio live today. So if you would like to, oftentimes I'll do the show from home. Actually, we did one, I think it was last week. I did it from home, but it comes in. So you can actually call in and ask questions even when I'm working from home. So that's pretty good. It's amazing, all the technology we have today. Sometimes it even works. Just kidding. But anyway, if you'd like to call, the number is 216-901-0945, 216-901-0945. And, I just thought we'd talk today a little bit, random topics, everything current, though. What we're seeing in the fixed income markets is really interesting. Short-term bonds are paying more than longer-term bonds are. They call that an inverted yield curve. We'll talk a little bit about that a little later on in today's show, where the most opportunities are in that environment, because there are a couple that I think are really good. Stocks are, if you're looking about over the next 1 or 2 years, and everybody always asks that, what do you think will happen by the end of this year? Well, you know what? Actually, I hate to break it to you, but your guess is as good as mine. As far as what's going to happen over the next 12 months, you may as well flip a quarter. And actually, the quarter's probably got better odds than you do, because the market can go up, down, or remain unchanged. Now, it's highly unlikely it remains unchanged, but it still is an option. So your chances of getting that right are 1 in 3. And I know most people think it's 1 in 2, but technically it's actually 1 in 3. But if you waited until it went up or down, then it'd be just like tossing a quarter. And that's what it is. It's kind of like tossing a quarter. I will say this, the underlying economy is incredibly strong. That's why they're raising interest rates. There's been inflation. It's not just because of the economy. It's not just because the demand is there. It's not just because the money is there. This one's really complicated because you have all the supply chains in Europe being messed up by the war that's being fought there. A lot of stuff going on in Taiwan with China, and an awful lot of military expenditures going on there. And is this stuff normal? Actually, it kind of is. If you go back and look through history, in the early 1960s, right around the era that I was born, so I really didn't know much about what's going on. I read about it later. But there was an awful lot of turmoil going on, and then you might have heard of this thing called the Vietnam War. That came along, and then they decided that, right near the middle of that war, that the government was going to create a program. I think that's where Medicare came in. Yeah, that was Medicare. So, and by the way, there was no funding for Medicare. I mean, the funding was zero. And so they had to come up with all that money, and it led to some pretty high inflation, which led to some really high interest rates. and it led to a stock market that kind of went sideways in a big, wide range for an incredibly long time period. It was over 10 years. Okay, so, and to make money using stocks, if you rebalanced your portfolio, let's say you had stocks, bonds, cash, three basic categories, and you rebalanced your portfolio, you would have made a decent return throughout that time period, depending on how frequently you did it. But when the stocks went down, if you were rebalancing, you were taking some of the money out of the shorter term fixed income and you were putting it into stocks. And then when it had a big rally and it was overweighted, you come back to, let's use a 50-50. So if you put 50% in the stock market, 50% in bonds or CDs or fixed annuities, whatever you chose for the fixed portion, when the stocks went down, you would actually take some of that money and add it to the stocks that you had. When the stocks went up again and rallied up big time, which they did, you'd have taken some of that money now that it was overweighted in stocks, and you'd have moved it back over to the safer side. And that's called rebalancing, actually. And, my industry, they really like to complicate things. I was listening to some financial planning commercials and some of their shows over the weekend, and boy, do they do a really, really good job. I mean, it just sounds so good, and it sounds really complicated. But if you're doing a financial plan, it really doesn't have to be very complicated. In fact, I'd rather go with the simplest answer. What is that? Occam's razor. Occam's razor is oftentimes the simplest solution is the best, or something like that. You can Google that if you'd like to. But anyway, and I'm in agreement. Retirement planning and financial planning, it's actually relatively simple. Now, picking out the individual funds, that's going to require a lot of time, a lot of effort. But actually, what you're looking for is relatively simple. It's just that you have to look a lot. I mean, there are thousands of funds available, and thousands of them that are actually different. There are a lot of, within those thousands, there are some that are actually identical except for the expense ratios. But if you take a broad look at all the available funds out there, I mean, there are literally several thousand choices. And that's a lot. I mean, these are funds. They're holding anywhere from 30 stocks generally up to 3,000. And they do it in many different ways, but it's just a lot. And I feel bad for individual investors out there trying to get their arms around this, even kids just out of college. It's going to take several years to learn everything that you could know about all these various options just in the fund. They're just in the managed money department, fund management. And realistically, do you need to know that? Not really. I mean, I can drive my car, but I couldn't fix it. I mean, you can operate a vehicle without knowing how everything actually works. But even learning that, it can be challenging. So anyway, what are the biggest challenges? Well, the biggest challenge I see, and it's kind of been my focus in this industry the entire time I've been in it, is earning enough on your investments to be able to retire one day. And I don't care if you're 22 years old and just out of school. Actually, you have a big advantage if you're listening to this, which most are not. But if you're listening to this, or you're out there and you've got kids or grandkids that are right around that age, you should have them listen to the show. And here's what you're going to need to do to tell them. Here's what I'm going to need to tell them. So take whatever income that you want to have in retirement. And by the way, this goes for people who are 60, getting ready to retire, thinking forward to retirement, for people over 50, for people over 40. It doesn't really matter the age. The numbers are the work is the same. You try to get an estimate. Now, if you're in your 20s, you're not going to have an estimate yet. Well, you might. Depends on how long you've been working. But try to get an estimate on Social Security or any pension you might have. If you're a school teacher, you work for a federal government, that's a lot easier because they've got these projections out there. Here's how much, If you're closer the closer you are to retirement, say when you get above 40, okay, or above 35 actually, when you get above 35 years old, just go to the Social Security's website, figure out, find out what you think that might be. Take your current income, multiply it by 75%. We're going to take that 75% of your income plus whatever the Social Security is. Now, they give you two methods of collecting Social Security or a pension. One of them is not adjusted for inflation, which means that if you were retiring today or within the next year or so, this is how much you would get. And then there's the one that's adjusted for inflation. So you have to make that inflation adjustment, and you're going to have to do that on your own. And you know what I'm going to do? I've been thinking about this for quite a while. I'm going to put together just a little sheet that shows a multiplication table. It's just a table. You can do this online if you'd like to. There are lots of calculators out there, but I'd like to keep things as simple as humanly possible. So if I take my income that I'm going to need, and then I multiply that by 0.04, that's the 4% rule. Okay, so if you don't know how much income you need, just figure about 80% of your current income is what you'd need to maintain your lifestyle, and you could do that relatively easily. Now, when I say 80%, people go, what? What do you mean 80%? I need 100%. Some people need 150%. I'm just saying that most people, or many people, could maintain their lifestyles without much of a problem if they were getting 80% of their current income. Now, remember, you're not working, and if you want to keep working, you can. But typically, 80% is a pretty good number. Let's put a little math to that. Okay, let's say I make $100,000. So 80% of $100,000 is $80,000. That's what I'm going to need. If I bring that on, if I'm going to retire 20 years from now, and the inflation rate, let's say it averages 4% over that time period. It's higher than that now, but it's been a lot lower than that over the past few years. If it goes at 4% over 20 years, it's going to double. Roughly, things will cost twice as much a little over 20 years. So if I'm making $100,000, that would mean I would need $80,000 today. In 20 years, that's going to be $160,000. Okay, now before you panic, this is where you go in and start checking on how much you're going to get from Social Security. Let's say you're actually at that age today, and you need $80,000 a year in income, and then you check for Social Security, and because you've been a pretty good earner, you're actually going to get $4,000 a month. I'm just pulling that out of thin air. So $48,000. That's $48,000 that I do not have to invest for. That's going to come to me from my Social Security. That's pretty good. That's really good. That's actually higher than the average. The average across the country. Now, and remember, the average has the disability people in it, people who had to work in some jobs that didn't pay a lot. So the average Social Security payment's it's a little over $2,000 a month, I think, right now. So if you're in $4,000, that's because you were a higher wage earner and you paid a lot more into it. There are a lot of people that I know of in this area. I talk to them all the time, and that's about accurate for them. And say right around 4,000. So anyway, make a long story short, if they needed $80,000 a year, they figured to be able to maintain their lifestyle and just do what they wanted to do, and they're going to get $48,000 from Social Security. That means they got to come up with $52,000 on their own. And if you multiply 52,000, I can't do this in my head, by the way, times 20, okay, that would be $1 million. It's a lot of money, right? Yeah, it's a lot of money. So if you got half of that, well, then that'll give you half of what you could get. And this is where it gets really tricky. You've got to go in and figure out, are you still going to work during retirement? Are you going to just cut back? Maybe it's easy for you to get by on that. But anyway, I'm going to write all this down, and I'm going to publish it in a little booklet. And it'll probably take me to get around to the whole thing about a month. And when I do that, I will, I've got a phone call coming in, and but I don't know who it is. So I could go ahead and okay, somebody's taking it. Sorry about that. 216-901-0945 is the number if you'd like to call in. And incidentally, I had somebody get really upset when I was talking about this. What I'm talking about is it's accepted in the financial planning field as the 4% rule. And I mean, people were upset because I was talking about it. Not my rule. It's not my rule. It's the rule that they recommend that you stick to when you're trying to do retirement planning. And I know what people are thinking. I hear it all the time. Well, the stock market's average 10% a year or 8 or 9% a year, whatever that is. That's the stock market. That's that market that drops 50% every once in a while. You see your investments cut in half and you're taking out more than 5%. You're not going to have any money. I mean, you'll literally run out of cash. Okay, that's where that 4% rule came from. Now, could you go to 5 or 6? You probably could. That's one of the reasons I like the annuities, because a lot of them will guarantee an income that's more than 4%. Now, it depends on your age. That's primarily the factor, the age and the company that you're dealing with. If you are getting a over 6%, as a percentage of the principal that you invested, and that's an income and it's guaranteed for as long as you live, and sometimes you put a spouse on there and it's for both of you. That's good. That means you don't have to take quite as much out of the other monies. Or if you do, at least and then the market does crash and you're still taking out a lot of money from the other ones, you still have that money coming in despite whatever happens in the stock market. Now, that's pretty good. And it's really good. I mean, I like it. I have them. The ones I've been talking about the last couple of years here, I'm just licking my chops because the income that I'm going to be able to generate from that is pretty substantial. And even with interest rates, as they've gotten higher over the past 2 years, like a lot higher, they're still not to the point of where that product is. I'm still going to get more out of that than I will if I were to put my money into bonds, which fluctuate a lot. I don't know how many people realize how much bonds go up and down. They probably do now, because I have been getting a lot of calls. Bonds will go up and down a lot. Now, if you're like me, and by the way, now that I hear the music, I'm going to take a commercial break. This is Bill Bullington right here on 1420. Stay tuned. I'll be right back. And we're back. Hey, this is Bill Bullington. I'm here every Saturday morning from 11 to noon. If you'd like to call us at 216-901-0945. I'm live in the studio today. I'm going to go to the phones right now, and I've got a caller. I'll have to call you caller number 1 and ask if I can ask for your name.
This is Andrew Channon. How are you today?
Good. How are you?
Well, we had spoke about ETFs earlier in the week and wanted to follow up on them for the show today.
Yes, I'm glad you called, and we're having a little bit of technical difficulty today in the radio station, which is why I had to ask for your name. But so Adam, we had talked a little bit earlier this week, and I think I'd let you know I do most of the work that I do on the equity side, particularly, and the fixed income side is in exchange traded funds. I think it's a really good way for the average investor to be able to do some things that are pretty sophisticated, but without having to worry about executing the strategy. And that's how I see these as a big relief. It's one thing to come up with a strategy. It's another thing altogether to try and run it. And so you have some that caught my attention, and I thought it would be a good idea to have you on so that you could explain them to my listeners. And so I'll let you take it from here.
I really appreciate it, Bill. And I got to catch some earlier parts of the show, and you're absolutely right. There are thousands of funds and thousands of ETFs that are in the market, not just here in the U.S., but this has become an investment vehicle that has grown popularity around the world. And almost all developed exchanges and less developed exchanges even offer ETFs now. And in the early days of these products coming out, you had, like going back to the Occam's razor example, you had, the simplest solution. So, think of, the mutual funds with the largest assets. There were essentially clones of ETFs that were created. And, there's some benefits and other aspects of the ETFs that made it desirable for people. But as time went on, you saw many more types of ETFs capturing all different types and parts of the markets, different asset classes, different geographical focuses. And it certainly has made it more confusing for people to sort through and find the ETFs and learn how each individual one works and operates. But at the same time, it's also empowered individuals, not just institutional investors and hedge funds and the biggest banks in the world, but it's empowered individuals to have tools at their hands to be able to develop their own global macro portfolio strategies and to really balance it based on their worldviews and the opinions that they want to express via their investment. And so we've actually, at my company, Procure, have come out with 2 ETFs that have been focused in the thematic space. So global equity focuses on specific industries. And our first one was the world's first pure play global space ETF. So realizing that people might be interested in investing in the space industry, but not necessarily understanding all the companies that are involved, not necessarily being able to get exposure to companies that are foreign companies listed on foreign exchanges, not necessarily wanting to keep up with rebalancing their portfolios as time goes on and new companies are added and old companies leave. UFO is a way for investors to get exposure to over 30 publicly traded companies from around the world that specialize in different areas of the space economy.
Right. I really like the sense of humor in getting the call symbol of UFO.
It wasn't necessarily the first idea that came to mind, but when we thought about it later on as we were developing the product, UFO became the ticker that we needed to utilize.
Yeah, that's really cool.
But certainly, it captures the imagination, and I think the space industry does as well.
It's huge. I mean, it's unbelievable. And when I look at people like Elon Musk and how far he's pushed that forward, and how many other companies have come into being just because, not just because, but he's been a major force in the development of a lot of those private companies. And so I think that's really interesting. And
you look at something like a SpaceX, and whether you agree or disagree with Elon Musk and his politics or not, what he's done through his company SpaceX, which is creating reusable rockets, has opened up so many opportunities for, exactly like you said, private companies and public alike, because they've lowered the cost of access to space via their reusable rocket technology. So the types of companies, types of individuals, types of government projects that can be experimented with and done become so much more possible and economically, doable because of this lower cost of access to space. So it's really opened up, tremendous opportunities for all different space companies and shapes and sizes. So, we're really at an interesting inflection point for the industry, and ETFs are a way that people can get exposure to now, industries such as space without having to necessarily become an expert in the individual companies themselves.
Right. With and it's a lot safer. I mean, when you said you have 30 companies in that one right now?
It's closer to 40.
Okay, 40. So that's a lot better than one. I see that a lot. Which company do you think? I really like them all, and it's incredibly difficult to pick winners that way. But what you're really talking about is trying to capture a theme for an industry that's in its infancy, that's growing fast, and probably going to be one of the faster growing industries over the next 10 to 20 years. So go ahead.
I can't say that it's safer or better than picking one thing versus another. But what was really important to us was aligning ourselves with an index where there was an expert on board that truly understood the industry. So one of the co-developers of the index that our fund seeks to replicate before fees and expenses was developed by a former director of the Space Foundation. And he was one of the individuals that developed the model for how the space report, probably the most followed, tracked, quoted annual and quarterly space outlook report around the world, he helped develop that model over a decade ago that actually tracks the size, the industries, the companies, the growth involved in the space industry. And so they actually dug down to look for companies deriving large percentages of their revenues from space. So if you look at UFO, at rebalance each quarter, you'll see that at least 80% of the fund is actually focused on companies deriving a majority of their revenues from space-related activities, businesses, and services. So it really is giving significant exposure to the theme which we set out in providing exposure to investors for in space.
Right. Well, that sounds really good. I really like the idea. I like the ideology, the methodologies that you're using. I think they make an awful lot of sense, and it's made my job significantly easier when I can locate someone that's doing something that I have an interest in, and this is definitely one of them. So I would let the listeners know out there, if you want to learn more about this, what's your website address?
You can visit procureetfs.com, and you can learn about the UFO Procure Space ETF or our newest ETF, FIXT, the Procure Natural Disaster Recovery Strategy ETF, which is pretty timely given all the events that we've seen around the world and even just east of you out in Ohio these days. Yeah,
that's been on the news all 24/7. So yeah, well, great, that's awesome, and thanks for coming on the show and taking the time today. And I'm sure we'll be talking soon. Is there anything else you'd like to add?
No, ETFs are a really interesting investment vehicle. There's a lot to learn just from reading through the prospectuses. But I would be thrilled to come on as a guest and help answer ETF questions and help your audience get a better understanding, whether it's about our products or others. It's something that I've been a student of since graduating college over 15 years ago now. So happy to be a resource if I ever can.
Well, that sounds good. Thanks again for calling in, and we'll look forward to having you back on the show.
Thanks for the time. Have a great weekend.
Thanks, you too. Bye. That was nice of them. And again, if you want to get information on that exchange-traded fund, you can just go to my website, Bullington Capital, request it. I'll forward you the information on it. I think it makes a lot of sense. The types of companies in there, they're not like Procter & Gamble, which is actually my favorite stock, but showing my bias there. But I think it's an area where a small amount of money could end up doing very well, given enough time. It's not a matter of, I think, if it will do well, it's when it will do well, how long it takes. And it's one of the reasons you got to be pretty careful when you're putting your portfolio together. If you like the idea of doing something like that, and investing in those types of companies, then you don't want to overdo it. And that's kind of the job of a fiduciary. I get questions all the time. Hey, what do you think of this? What do you think of this? And I'll take a look at it. And that's actually a big part of my job, is being a sounding board. And I'll bring up the pros and the cons. And, on something like this, would I put a huge position on? Probably not. I haven't looked at the individual companies that make up that fund yet. But even if I did, just knowing the index and the industries, I know that they're in the early stages. But that's fine. And when they're in the early stages, you typically don't want to have a tremendous amount of your money in something like that. It's not the prudent thing to do. But it depends on how young you are. I mean, I'm not really a gambler, and I like to try to have an idea of how much risk I'm actually taking. And once you can see what's inside of a fund, and if you know how to do valuation at all, my favorite is to look at a price to sales ratio. It's a little more complicated. The vast majority of people, when I was coming up in the industry, always looked at the price to earnings ratio. Well, there's and that's okay. If you like doing that, you just have to know how to estimate earnings yourself, and not even be super expert at it. But you got to be comfortable with financial statements, because earnings, in my view, were an opinion in a lot of cases. And I know all the CPAs out there, if there are any that are listening, they're just kind of chuckling right now. But the bottom line is the earnings may not be the actual earnings. sales are really hard to disguise and manipulate, and harder, I should say. And anyway, I'm really getting off the point here. It was very nice of him to call. And again, if you want more information on that ETF that's going to invest in spacecrafts and outer space and stuff, like Elon Musk's companies, that's definitely coming in the future. And I feel kind of like it's like the computer industry was back in the 1970s, before Steve Jobs actually started rolling out the first Macintosh computers. Yeah, that's about where that industry is. And within 10 years, it's going to be big. So, and like I said, you don't have to put a lot of money into it, and it's being run intelligently. And quite frankly, I don't put a ton of my money in any one thing. That there's a reason for that. I've seen a lot. When I was younger, I did that, and that's how you learn. Experience is a great teacher. I just wish it was somebody else's experience that I was learning from. But that's what people have an opportunity to do today. It is so difficult because you do have so many. Literally thousands of stock funds. There are thousands of stock funds. If you add up the funds that have all the asset classes in them, they're tens of thousands. That's a little intimidating. And to really do a good job, you've got to be willing to spend an enormous amount of time trying to study this. And if you don't want to do that, well, that's actually why my career even exists, is because all the information's out there if you have the time and you're willing to put in that kind of time. And a lot of times you put in a lot of time, and then what you find out is that now you've got to put in more time because it took you a long time to study to get to one certain level, and there's a whole lot more to go. But anyway, and it's another reason that I try to keep things as simple as humanly possible. Like I've overweighted in a lot of the funds in my own personal stuff, healthcare, which over the past, since the pandemic hit, it actually has not done well, which I laugh about it. First of all, because I didn't put, I think I got less than 10% of my money in those funds, and they're diversified amongst several hundred companies within those three funds. So I'm not worried about it. And healthcare is one of the faster growing industries in the world. Big part of that is the aging of the population. The older you get, the more frequently you go to the doctor. And, their revenues, their sales have been going up consistently at very high rates. So, do I think it's a bad investment? No, I would take my money out of it if I thought it was. It's actually more undervalued now than it was when I bought it because the sales have gone up and the share prices are slightly lower. Now, on the other side of that, I also, I've been talking about investing in semiconductors, and I've got a little model. I've got 4 or 5 funds, depends on how big the account is. We invest in these, and we get a really good representation of that entire industry throughout those 3 funds. And that's done incredibly well. You're not allowed to talk back if your timing wasn't good, if you were unlucky, if you stayed in it past the point that it was overvalued, like the late 90s. If you were to look at a lot of the stocks that make up the names in there, they were selling at valuations that they had never sold for. They were 2 to 3 times higher than the highest valuations they'd ever sold for. That's not good. When something's normally selling for 12 or 15 times its earnings, and all of a sudden it's selling at 100, that's not good. What would you rather pay, 100 or 12? Come on. So that was the situation that was in. I didn't have any of those stocks or funds at that point in time. I just didn't feel like it was a good investment. So, and you can't guarantee wins, by the way. We're not allowed to do that in this industry. You got to do the best you can, keeping it as simple as possible. That's kind of a key. Paying attention to things, sales growth is the number one driver of any industry out there. So that's kind of a key thing to do. Learn to balance your portfolio between fixed income and stocks. That's going to be really important now. And I know a lot of people who have been investing in fixed income and invested in the wrong kind the last couple of years is really upset. They're really upset because it's down a lot. Anyway, you hear the music. That means I got to take a real quick commercial break. This is Bill Bullington right here on 1420. Stay tuned. I'll be right back. And we're back. Hey, this is Bill Bullington. If you hear anything you'd like more information on, feel free to go to my website. It's bullingtoncapital.com. And just give us a email if you or there's a contact us page, so you can fill that out. And what's really funny about the contact page is 9 out of 10 people that fill in their information forget to ask the question. So, I mean, I'll email you back and or even try to call you back and find out, what you're looking for. But yeah, that would help a little. So anyway, but I started this show out, and I'm listening to other ads from other people that do what I do for a living, and they're so nice, and they're so sounds like they've got it all together, and they've got all this stuff in there. And I'm like, wow, I wonder if they even realize, because the College for Financial Planning teaches that you have to start with this a budget, and they go on and on and on, and there are thousands of pages they've written over this stuff, and I'm like, really? It takes you thousands of pages? It sounds really nice. I mean, it sounds very impressive, but the reality is, you just need a budget. You just need to know how much you spend. What are you spending on a monthly basis? Now, I know that's hard. I mean, for a lot of people, they don't know. But if you've got a budget and you've got savings, then you can see how much you may need to try to make and on the investments to try to keep your lifestyle the way that you'd like to have it. And it's really not all that difficult. What gets difficult is when somebody needs to generate returns that are, 10%, just to meet those goals. Because the only way that you can do that is by taking a fairly significant amount of risk. And that's going to kill people. And I know I'm going to get some more hate mail, because there are people out there in my industry that'll show you a return on a fund that's averaged 10% a year for the last 5 or 10 years. Even 12 years, and say, well, look, he doesn't know what he's talking about. Well, if you look at the ups and downs in that fund, it may have done that. And if you look at the Russell 1000 Growth Index, it's done phenomenally well. Look at the Mid Cap Growth Index. It's done incredibly well. The problem is, when the market goes down, so do they. They're not oblivious to what's going on in the rest of the world. They don't just go up 10% a year. It doesn't work like that. And I feel obligated. I mean, despite the fact that I am legally obligated to disclose things like that, like that's called risk. And they like to call it standard deviation. They've got all kinds of words for it. Standard fluctuation. A lot of stuff that, doesn't happen that often. That's a 100-year event. No, the statistical methods that they use, I think, understate the amount of risk that people are taking. And I know why they do it. I'm not in agreement with it. And I really think people would be much better off if you just told them like it was. Hey, look, market was down 50% back in 1972 over the next 2 years. The S&P was down 57%. Now, there were some value-oriented funds back then that didn't go down that much and actually had recovered long before the stock market did. But today is a little bit different story. Very difficult to find a company that's going to vary significantly from major indexes, because there are so many fewer stocks out there to invest in, and there are so many more people doing it. But bottom line is, you should try to keep it relatively simple. I think BlackRock does a really good job. I know a lot of people don't like BlackRock around here because they're kind of liberal, I think. Quite frankly, they're liberal, but I don't pay attention to that. I'm paying attention to what are you going to do with the money? A lot of the funds that they have are tops in their category. So, they've got some funds and they've sit on some boards, and I get it. They're not doing everything, but they've got what you need. They've got a lot of stuff that you need. And you don't have to use them, but they've got what you need. And the fund, the guy that's running the company does not manage every fund there. Actually doesn't manage any of the funds. So, you might as well use their tools. And they've got a really nice tool that you give them your age and the amount of assets you have and the any Social Security or pension you have, and it'll show you, based on what kind of risk taker you are, a level of income that you should be able to maintain in retirement. Now, I'll run that report for you. It's going to take me about, probably 15 or 20 minutes. It's probably going to take you a few hours. So gathering the data is the hardest part. So when you do gather the data, and that probably, I don't know, it depends on how well you do that. I'm just saying over the last 30 years, I've been doing this. The vast majority of people, they have a general idea of how much you're spending each month, and that's really all you need. You don't want to miss a big item, though. That's not good. So, but if you have a general idea of what it takes, what are your basic living expenses, that's great. You can start with that, and you don't even have to do that. You could just take the amount of money that you have now saved, put away for retirement. Could be 401k, IRA. Just know what that is. Try to get an estimate on what your Social Security is. If you don't know it, I can show you how to do it online. It's like 5 minutes, and you can get an estimate of what that Social Security is. If you got a pension through a school system, or you're a fireman or a policeman, you guys get reports on that all the time. I can help you go through that and understand it. And within within probably 20 or 30 minutes, especially if you're in the office and you have that information, we got a plan. That's all the time it takes anymore. Thank goodness for all these computers. And by the way, thank goodness for the computers. But I'm telling you that we are decades away from self-driving cars. That is literally, we don't have the infrastructure. And I have a place in Powell, Ohio, and so I'm going back and forth there quite often. And when I'm going down there, my phone calls get dropped, 3 or 4 times. That's in Ohio. That's on 71. My phone, there's no way. Driverless cars have got to maintain. You can't be losing your connection. And when I look around and I see all the farmland out there and the miles and miles where there's nothing. Okay? Yeah, it's going to be a long time. Is it coming? It's absolutely coming. Is it going to be here tomorrow? Heck no. And a lot of the companies, vendors that we deal with, they're going down during the day. Nobody's talking about this. I'm going to tell you about it. And I know you're probably frustrated at home trying to log in and use any services that you have over the internet because you're getting timed out. You'll get timed out, and sometimes it takes an hour, sometimes it takes a couple of hours to log back in. And it's intensified ever since the onset of the pandemic. In my mind, is when it really started getting tough. And I'm spending more time than I've ever spent in my entire career. Now think about that. I just turned 60. Thank you very much. My entire career, I am spending more time sitting in front of the computer waiting than I have in my entire career. Because before, we just knew you couldn't do it. If there was a task out there that you couldn't do, we knew you couldn't do it. But now we're trying to do tasks, everyday tasks, and it's taking time, like a lot of time. And I don't understand. I've got the fastest internet speeds available. They're commercial in my area. And doesn't matter from home, from Columbus. It's just amazing. So don't think it's all you. And that's another thing that when you're working with an advisory firm like ours, not only will we help you with the planning, okay, we'll actually be the ones staying on the phone, holding, talking, waiting to talk to somebody so that we can get done what you need to get done. We take that over for you. Okay. Now, you can be on the phone if you'd like to. And we do conference calls all the time. But you don't have to be, and we will actually sit there and wait until we get to talk to somebody and get the answers that we need to get. And it is incredibly frustrating to have to go through all this stuff, and I'm hoping that it gets better over time, and I'm sure it will. I'm sure it will. They'll figure this out. And but in the meantime, it's can be very frustrating. All this stuff that you hear, I feel just so bad for people. Everybody's got an ad. I mean, it's just, and the ads are written by people who have studied human behavior tremendously. So they're creating they create a lot of stress. Like I said, the planning aspect of this is really not that hard. And if you call in, I can do a retirement income plan. If you know how much you have in savings and you know what you're going to get in Social Security or in a pension, I can do that in about 5 minutes. Okay. And I'll make that offer. If you want to see that, there's no cost to doing it. And I'll do it for you. If you're one of my clients, I'll do it for you, especially if you're one of my clients. Not all my clients have that, by the way. And I've talked about this more than once on the show, but not into this detail. And I'll promise I'll continue to do this on future shows. But I've only got about 10 seconds here before the music starts to come in and drown me out. So if you see anything or if you've heard anything that you want more information on, just go to my website. bill@bullingtoncapital.com is my email address. bullingtoncapital.com is the website address. And I would be glad to share any information I have with you. Have a good weekend, everybody. Good luck. Good investing.
Just caught another edition of the Bullington Capital Report, broadcasting every Saturday at 11 a.m. on AM 1420, The Answer. If you have a question and you'd like to speak to Bill personally, you can call him at 330-664-0700. That's 330-664-0700. Or online at bullingtoncapital.com. That's bullingtoncapital.com.
The preceding program has been paid for by Bullington Capital Management, LLC.